I think that we are seeing some improvement in the credit markets. The leveraged loan market's probably a good example of that. We are seeing some improvement in spreads. And I think the real risk going forward here is how much do all of the problems in the financials and credit markets seep into the real economy. We are planning for a slower and more difficult next couple of months and probably next couple of quarters. But we're also optimistic for our results for the full year 2008.
There's still a number of reasons why there's challenges in the credit markets that don't have an immediate answer to make them go away. So we still have a very fundamental problem in the mortgage market. We still don't have what I would call a holistic solution to what's happening in the residential mortgage market. We still see deteriorating fundamentals, not as extreme, but on some level in the commercial market, reflecting the greater economy reality. I think we've seen some stabilization in the leveraged loan market. We've had some pullback on the sensitivities related to the monoline industry, but there's an overwhelming negative sentiment that still is out in the marketplace that I don't see reason to be too optimistic about it changing, or what the real the real catalyst for change would be over the next several months. So I think we still got to look at this as a multi-quarter event still continuing from here, and we've got to look out to 2009 as where we change.
Contrary to what some people think, no one is hiding losses. We are taking the proper valuation at the end of each quarter. People are disclosing their positions, so actually you know what positions banks have now, and everybody can calculate the potential markdowns. But if things continue to stabilize, of course, the worst is behind us. And up to now, we normally have seen phases of stabilization, and then, unfortunately, something like a shock incident happened, and investors got very nervous again. So let's hope that there is no further shock incident of a substantial magnitude, and then I think we will see that markets start stabilizing and that investors are coming back to the market.
As long as the economy remains weak and housing prices continue to slide, credit costs are going to be high. They're going to be high for the industry. With housing prices declining as they have been now for several quarters and probably continue to decline for a period of time, equity in homes is being diminished, in some cases evaporating. That's an issue for home equity lenders. We are a home equity lender, and that's really where the bulk of our credit costs are coming from at this point.
More houses are going negative equity, roll rates are high, home prices we expect to still go down. The risk factors in prime mortgage are exactly the same you've seen elsewhere, which is negative home prices, high LTV, things like that. And I think it'll probably get a little bit worse, but it's hard in almost all these mortgage areas to say exactly what's going to happen to behavior. And you can guess as easy as we can what's going to happen to home prices. We expect they'll go down another, 7, 8, 9% in 08.
I think we're near the end of it because most of the bad news is already in the market. The write-downs are coming in fast and furious. People are talking about mortgage failures, et cetera, et cetera. So I think the market has already accounted for that.
In terms of asset write-downs, I think we all can expect to see more. In terms of specific asset deterioration, we're not necessarily finished, particularly if fears of the economic slowdown materialize, that we move from financial markets really into the real markets. But our measure of global investor risk appetite and of credit risk appetite is starting to emerge from the panic zone, and this has been helped enormously by the Fed's modernization of the discount window. And clearly we're seeing new money is starting to come into the credit markets in response to implied default rates that are in some cases consistent with the Depression era.
I don't believe that the credit crunch is remotely over with yet. And I think the next place where you're going to see it in very large effect is going to be the regional depository institutions. I think people forget that in the last crisis of this sort, the savings and loan crisis, from 1986 to 1990, something like 1,500 depository institutions failed. I believe this crisis is more serious, and therefore I believe there will be a substantial number of them that will fail again this time, and thereby create potential investment opportunity.
Finally,